You're naturally long, you got to think about selling and protecting the downside. So if you buy an option, you have no margin call risk whatsoever. You have just essentially the only risk you have is the premium that you pay for that option. Okay? But if you sell an option, you now have a potential margin risk. Put options used as price insurance. This is how you can secure a floor price without selling to the elevator.
We've had 15% of folks that's never used options. We have 31% of folks that have heard of them, but they've never pulled the trigger. That's the largest segment. We have 13% use them through an elevator. 27% of folks, 15 out of 55, have their own trading account. Good for you. Hopefully you haven't blown it up a few times like I have. Learning the hard way. And then use them regularly with an advisor. 24%, that's high. That's good. That's good.
Even with only 55 folks on here, that's actually a very high percentage of folks that do have their own trading account and use them regularly. So kudos to you guys. Well done.
Well,
Well
it's probably
done.
those folks tuning in, that
It's
know
true.
the value of it for sure. So
It's true. I ask brokers on a regular basis, like what percentage of farmers do you think use these? Most of them have single digit, numbers back to me. Not even ask them this, of your
wow.
clients, how many of them actively trade? And, they might have a book of 200 or 300 different, farmer clients, and they say probably 30% might actively trade. So,
Well, and if you're a 5,000 acre farmer, how long the market are you with wheat and canola?
yeah, great question.
A lot. The answer is a lot. Probably David can think about that and do some math there with OpenAI or something, get back to us. But you think about it, it's essentially your net revenue that you're long one way or the other. So continue on there. Thank you. I think we're making headway.
Okay. So, talk about call options. Now, put options. This is the one most farmers would probably be the most interested in, because you're naturally long. You got to be thinking about selling and protecting the downside. So, a put option is effectively the opposite. It's a financial contract that gives the buyer the right to sell the underlying futures contract at a strike price on or before the expiration date. So essentially, you would use one of these if you are bearish the market. You would buy one if you are bullish, or sorry, if you're bearish. If you were bullish the market, you might sell one. You might sell one out of the money because you think, hey, I would like to buy something back down there if that happened. The exact same thing. The value is built off of those factors that I talked about. Now, again, I say this again. The words I put on here, this is an oversimplification to how those options are valued, but not everybody needs to know about all the Greeks. And again, right now, here's what the current market is in terms of premium to be able to buy each one of these. So if somebody was bearish July canola and they want to protect a 742, which is approximately where it is right now, it might cost them $38 to protect that downside. Okay, so a lot of times people say, that feels a little expensive. And yeah, it is. It is because again, the volatility in the market right now and the amount of time that you have to pay for these options do start making the sticker shock on these a little, a little real on that side. So, but we're going
Barry
to talk a
Rutledge
little bit
is
about how.
asking, while most put and calls have no margin call, explain how or when there is risk of margin. Example, war.
Okay, so if you buy an option, you have no margin call risk whatsoever. You have just essentially the only risk you have is the premium that you paid for that option. Okay. But if you sell an option, you now have a potential margin risk. So if I was, in my previous example, if I was bearish canola and I sold an $800 call, if the market appreciates closer up to that 800 and that $800 call becomes in the money, then all of a sudden I would be subject to potential more margin calls from my broker. That's where it's the same as using, buying or selling the straight up physical commodity at that time.
Great discussion. We're 35 minutes in. Thank you for all the questions. Ryan, can we get to the strategy here and then get talking to Derek a bit? Because
Yes,
we want to get to David too. So let's
you
expedite
betcha.
this a bit and get to her.
Okay, so quick on this side, put options used as price insurance. This is how you can secure a floor price without selling to the elevator. If you are having anxiety about contract cancellations because of a production shortfall, that's exactly where puts help you. Exactly where puts help you. And this is a market where, hey, the value is becoming within range on doing these things responsibly. You can buy or sell these options out of the money. And the main thing I would say to everybody is if you buy an option, you don't need to hold it to expiration. For example, if you bought a November put option now for $49, but then you only need to hold it until June because then when you're comfortable in selling some physical, you might be able to recover $30 of that $49 that you put out on that option. And I put it to context in this and everybody. Imagine if you could, on August 1st, get 40% of your crop insurance premium back because you're no longer worried about a drought risk at that time. Okay, you can't do that with your cropping insurance, but with an option, you can sell that option back and collect some of that premium that you paid back for it. So again, it's very, very flexible to use. Here's the current option market. Not everybody may be able to see this, but this is approximately the values of the November market, calls and puts on this side. So the thing that we're going to be talking about here today, guys, is how to cheapen up some of these options. Okay, so I want to go back to this chart. Here's the at the money, approximately 720. And to buy a put on November, 45 bucks, 48 bucks in this range. But if you're willing to buy an out of the money put, so something further down in this range, in this 630 range, okay, you might be able to buy that for a little bit cheaper, something like 12 or 11 bucks, but you're also taking a much lower floor. So that'd be one way to make these options a little bit more cost effective on that side. All right, so again, example, maybe you'd buy a 660 November canola option put for 20 bucks. It establishes a floor for you for about $14 a bushel. There's absolutely no upside price restrictions on this. If the market goes up to 850, you are able to collect all the upside above the 660 on that side. The only risks that you have is this is a lower floor price on your production than what you currently have right now. And most of the time,